Now going back again, I hope it's clear to everyone why it's important why we have to have reporting periods. This allows us to provide useful information by giving timely information. Okay, and we cannot just wait for the end of the life of the business to provide financial statements. There's a constant need for financial information, and to provide consistency and comparability class, we will provide financial statements uh, throughout a uniform or consistent reporting period. Information about possible future transactions class and other possible future events will be included in financial statements if it relates to the entity's assets or liabilities, or if it is useful to users of the financial statements. Again, these items class are very broad class because again we are talking about the conceptual framework. Okay, when we discuss the standards already class, there are actually specific provisions that would tell us when do we include future information class. Okay, you have to understand that the information that will be contained in our financial statements class would be based on past events. It's not forward looking. Okay, it's both uh, backward looking and present looking class. Okay, for example, your income statement is somewhat backward looking because it provides you information with uh, your income expenses throughout an entire period, not just for the particular end of the reporting period. Whereas your statement of financial position class, your balance sheet, is present looking because it tells you of your assets and your liabilities and equity on a specific date, on a particular date, which is our reporting date. But we normally do not include future information class. However, there are instances in which our financial statements, particularly in the notes to the financial statements class, will provide future information. Very rare class, very rare will our balance sheet, income statement, and our statement of cash flows and changes in equity will contain futuristic information. uh, Futuristic information that are useful to financial statement users class will normally be contained in our notes to the financial statements. Okay, and again, as I have emphasized before, the notes to the financial statements is one of our financial statements. Okay, so here class, I've highlighted paragraph A here. If the information relates to the entity's assets or liabilities, including unrecognized assets or liabilities. Plus, uh, we have what we call your contingent assets and contingent liabilities class. There are contingent liabilities class that do not warrant recognition but warrant disclosures in your notes. When I say do not warrant recognition class, they will not be recognized as an element of the financial statement. They will not be reported as an asset, liability, equity, income, or expenses. But because of their potential effect class, for example, contingent liability, because of the relevance or the significance and materiality of a potential liability class, of a contingent liability, the standard PAS 37 class, Philippine Accounting Standards 37, tells us of certain instances in which a liability class, which is not yet existing, that is still a possible class, can be recognized uh, in our notes of the financial statements. Also, we have provisions class. These are provisions that are uncertain as to amounts or timing class, but will still be recognized because they are existing and they are from past events. Okay, but if it's still possible that even if we have liabilities that are not yet existing, that will require recognition class in the notes of the financial statements if they are material class and if they comply with uh, the conditions set in past 37. Okay, but what we have here class in the conceptual framework is more of a broad concept class. It tells us that even information that are future oriented can still be reported provided it relates to paragraph A and B here. Okay, but again, You need not concern yourselves with these provisions because we have Pass 37 that specifically governs the recognition of contingent assets and liabilities, class. Then here, class, financial statements include information about transactions and other events that have occurred after the end of the reporting period. Okay. Again, basically this tells us that you may provide additional disclosures, class, in the notes of the financial statements, even for information that have occurred after the end of the reporting period. We have another standard, class, that governs the accounting treatment for events that occur after the reporting period. Okay, it's possible that because of events that will happen after the reporting period, you will have to make adjustments to the financial statements that you have prepared for the previous period, class. Say, for example, the reporting date, the end of the reporting period is December 31, 2021. Okay, and you have already prepared the financial statements for the period ending December 31, 2021. But because of events that happened shortly after the end of the reporting period, class, you will have to adjust your financial statements. Okay, so here we really need not concern ourselves about this part of the framework, class, because we have a specific standard already that governs these kind of events. If I can remember it correctly, class, events after reporting period is governed by past 10, okay, which is one of the uh, early topics that will be discussed in this subject. Now, an important concept here would be that the preparation of financial statements, class, is done in the perspective of the reporting entity. This is another reason, class, uh, why it's important that we observe the separate entity assumption. Okay. So it's important for you to know that the financial statements are prepared in the perspective of the reporting entity, because if you are dealing with risks, class, the risks that you should be measuring should be the risks that pertain to the reporting entity. If you're dealing with valuation, class, then it should deal with valuation that is related to the reporting entity. Always from the perspective of the reporting entity, class. Now, here it tells us, class, that if the reporting entity is no longer operating under the going concern assumption, then the basis should be presented in the should be disclosed in the financial statements. And again, we do not need to know that here because past one, class, the next topic after the conceptual framework, will discuss more on what to do if ever we are no longer working under the going concern assumption. Okay, but at this point, it's important that you get to be familiar with the going concern assumption.